The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The stock market rally barrels forward, but exactly where? No one knows. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. on this Monday, 2 days ago. Until the Fed meets, you're looking at a rally. The S&P 500 higher by about 0.4%. We're just off of session highs. You can see it's big tech that's really leading the way here. The Nasdaq 100 higher by about 0.7%. I thought this was an interesting dynamic and one to keep an eye on. You actually have the VIX higher right now. The VIX trading with a 15 handle, getting closer to 16, even though you have stocks up. So we'll see how that develops. But then you take a look at what's going on in the bond market. A little bit of a rally as we count down to Jerome Powell. The 10-year yield currently lower by about 3 basis points remain, but still just above 4%.
Interesting price action to start off the week, but I want to focus on one big number, and that is $10 trillion. That's the value of what's been added to the Nasdaq 100 since its April low. The S&P, which has, of course, 5 times as many stocks, has added $14 trillion. Those two numbers really encapsulate the stunning yet narrow rally over the past 5 months, and it's brought us to this inflection point as investors now grow more dependent on the start of a Fed rate cutting cycle to not only prolong the rally, but broaden it as well.
So I think the market is, shares the view of Jay Powell that the downside risk to the labor market outweigh the upside risk to the inflation. So therefore, rate cuts are warranted. But I think the question is, how far are they going to go over the medium to longer term? That's where the markets, I think, may be a little bit ahead of themselves.
Of course, the irony is that whatever the Fed decides Wednesday, that decision could potentially actually disappoint. A quarter-point cut may not be seen as well, not enough to address weak labor conditions, and a half-point cut may alarm investors that the economy is in worse shape than thought. Strategists from Morgan Stanley to J.P. Morgan, even to Oppenheimer, warning that a more cautious tone for equities may sort of bubble up and replace the recent bullish mood. And it's not just the question mark on rate cuts, nor the question mark on tariffs, but also the question mark on the durability of the tech trade. A reminder came overnight with China's decision to launch investigations into auto and industrial chip makers like Texas Instruments, just as those U.S. government trade talks are set to begin over in Spain.
And we'll dig into that, but we have to spend a lot of time talking about the Fed today. Romaine was just talking about the dual mandate there, the upside risks to both. I want to focus specifically in when it comes to the labor market. Here's a really interesting chart behind me. You have the 2-year yield in blue. That's, of course, where traders price in their Fed rate cut expectations. And then you have the U.S. labor market surprise in white. And you can see that really since March, the surprise has been coming down to the downside here. And you can see that the 2-year yield now is back to roughly tracking that. If you train your eyes on the March to June area, there was some divergence between these two lines, but now coming back together, moving in the same direction, suggesting, Romaine, that this is a market that is focused on the labor market, and it seems some concerns there.
All right, let's kick things off to the close with Mike Contopoulos, Deputy Chief Investment Officer over at Richard Bernstein Advisors. Mike, let's get it out of the way. First and foremost, Wednesday, we get a rate cut.
Absolutely.
25 or 50?
I'll go with 25. Yeah, I'll go with 25.
All right, you go with 25, but then the next question really becomes, is this going to be the start of an actual rate cutting cycle, or is this going to be a one-off where the Fed has to step back, maybe assess things, and maybe that puts not only them in a bind, but maybe the market as well?
Yeah, I think it's going to be a 25 basis point cut and a lot of data dependency after that. Listen, I don't think we've seen the full effect of tariffs yet, how that's going to affect corporate margins, how it's going to affect the labor markets. As corporate margins get shrunk, you'd expect more and more layoffs, nor, most importantly, how it's ultimately going to affect inflation. And so I think the Fed's going to have to be on wait-and-see mode, and the market may be disappointed by that, as they would expect the beginning of a rate-cutting cycle.
Well, one thing I'm curious about here, because we talk about this idea of what the Fed is actually cutting for, or at least what the reason they would be cutting for. If we do start to get a prolonged rate cutting cycle, and more importantly, if you get maybe a 50 basis point cut or something, if not in September down the road, isn't that a signal that something might actually be fundamentally wrong with our economy? And is that in and of itself be a reason for the market to be a bit more bearish?
It is. I think, the market by and large wants to have their cake and eat it too at the moment. They think that Fed cuts in and of themselves are going to, create a Goldilocks environment for stocks that it means that, earnings growth isn't going to slow very much, labor is not going to weaken very much, and that you're going to have, lower rates. And that, of course, would be great if that were the case. The reality is, remember, the Fed isn't really helping markets and the economy until they're well below neutral. One cut doesn't do that, two cuts doesn't do that. By the time you fall below neutral, things have gotten pretty bad, right? So this kind of idea that we're living in a Goldilocks where corporate earnings and labor and inflation are all going to be, modest, I think is a bit of a pipe dream and fairy tale for investors at the moment.
So when you talk about neutral, let's talk about terminal as well, because it's interesting. If you take a look at the market implied terminal rate now, it's about 3%. Is that synonymous with neutral? How far off do you think we actually are?
I think we're fair ways away from neutral. I think the neutral rate is actually probably today quite a bit higher for sure. But that changes over time. Neutral is just sort of a nebulous concept. And so as you get sort of slower growth and things start to fall off a cliff, that neutral rate should change along with it. You probably will settle at the Fed funds rate, I think, during the next recession, right around probably 3%, maybe a little bit under. But that's a ways from now, we think.
Well, it's a fun question to ask because it is so nebulous. But let's talk a little bit more concrete in terms of if we are embarking on a rate cutting cycle, what is the cleaner trade here? Can you express that more easily in equities or in the bond market right now, specifically in treasuries?
Well, again, I think it kind of depends on why that rate cutting cycle is really beginning. If it's due to a true fall off of economic growth, higher unemployment, that eventually will create demand destruction such that inflation begins to roll over. And I do think long-term treasuries in that environment will prove to be a safe haven asset once again. But there's probably going to be a medium term in between where if you begin a Fed rate cut cycle without the subsequent fall in economic growth, that would actually be away from long-term treasuries. So I think it very much depends on horizon and the depth to which we're talking about economic growth and where it ultimately goes. So right now, I think the safe haven trade is probably the belly of the treasury curve, agency mortgage-backed securities. And if you want to step out a little bit, maybe long-term munis, but that's a whole nother discussion.
Is there a question to be had about the fiscal situation, or are we just kind of over that?
Well, no, I think it's definitely a discussion. It goes along with that idea that long-term treasuries, probably have, in some aspects, in some state of the world, quite a bit higher to go. I think longer term, over a secular perspective, fiscal concerns, deficit worries, in addition to structural inflation, probably make the long end pretty unattractive from a secular point of view. But cyclical forces will always remain, in my view. And so if growth really stumbles, I don't think the sort of the fiscal aspect is going to hurt the long end. But sort of on a longer term basis, it's very much good.
And before I let you go, let's just quickly talk about the equity market here, because I'm taking a look at your notes that you sent over to our producers. You say, look for certainty and quality in utility, staples, and even healthcare. And those names stick out to me. Healthcare, your lone losing sector on the year. Staples also pretty far down the list. Utilities does have a little bit of the AI play, but for a lot of people, these wouldn't be natural first choices. Yeah,
you want to go where the puck is going, not where it's been, Katie. And I would say in that respect, obviously those sectors have underperformed as you've really been in a growth and momentum trade, particularly since the lows in April. And so I think those sectors will have their time to shine. They all, of course, like any sector at the moment, have their own idiosyncratic difficulties, but they are defensives. And if you do get a slowdown in economic growth, you need to still pay your bills. You need to, eat food. You need to go to the doctor, unfortunately. And so I think as growth slows, as unemployment accelerates, as margins shrink, the classic defensives are going to continue to fare well. And they are, as you mentioned, pretty reasonably valued at the moment.
All right, Mike Contopoulos, Deputy Chief Investment Officer at Richard Bernstein Advisors. We started off talking about the Fed decision on Wednesday. That decision, not much of a mystery, but longer term, a lot of questions about what the Fed will look like. Reuters reporting that former St. Louis Fed President Jim Bullard did actually meet with Treasury Secretary Scott Bessent about becoming the Fed chair. We should point out Bloomberg has been reporting since at least early August that James Bullard was on the short list, along with Kevin Hassett, Christopher Waller, and Kevin Warsh, among some other names here, as potential contenders to be the next Fed chair, presumably when Jay Powell's term is actually up next spring. Yeah,
and the clock is ticking, as you mentioned, May 2026, when that Fed chair period expires. We also know that Rick Reeder is on the list as well and moving up, according to Bloomberg reporting coming on Friday. Still a very big field here.
Yeah, and we should point out this is going to be a big overhang of this meeting, not just what the rate cut decision is, but who's actually going to be making those decisions in 2026. We should point out Lisa Cook still not even confirmed yet that she will actually be able to attend the meeting starting tomorrow because of that lawsuit that still has not been resolved. All right, a lot more coming up here on the show. We're going to take a look at investor sentiment when we come back and where Wall Street money is flowing. Thomas Peterffy going to be joining us, the chairman of Interactive Brokers.
And from stock charts to social media feeds, we'll discuss the future of the content creator and how a new deal for TikTok could help spur an already booming market with Gary Vaynerchuk, chairman of VaynerX, and John Hu, the co-founder and CEO of Stan.
And we are going to talk about the Fed, what comes next here, and who better to do it with than former Kansas City Fed President Thomas Hoenig. Stick with us. This is The Close on Bloomberg.
Well, China is cranking up the pressure on NVIDIA, saying that it violated anti-monopoly laws when it bought networking gear maker Mellanox Technologies all the way back in 2020. Now, this move comes in the midst of high-stakes trade negotiations between the U.S. and China, with NVIDIA just the latest bargaining chip on the table. Joining us now is Tom Orlik. He is chief economist over at Bloomberg Economics. And this has been the state of play for a while, right? That NVIDIA and chip makers in general were really caught in the crossfire of these trade negotiations. Still the case today, clearly.
Yeah, I think that's right, Katie. I think if we think about this from Beijing's perspective, they've got conflicting objectives. On the one hand, they would dearly love to have unlimited access to leading-edge chips from NVIDIA to accelerate their artificial intelligence progress. On the other hand, they recognize that the US is using access to chips as an instrument of control and negotiating leverage. They don't like that. They want to develop some leverage of their own, and they don't want to build in dependency on a US technology which they know could be taken away. So I think what we've seen in the last few weeks, and certainly over the weekend with this announcement of an antitrust verdict against NVIDIA, is the balance tipping towards a little bit more aggressive action from Beijing.
Well, that's what I'm curious about, too, is what position China is in. I mean, we cover this debate on this show, usually through the lens of the U.S. strength or whatever the perception of U.S. strength is. But we've seen China make a lot of moves, quite frankly, dating all the way back to the first Trump administration, as well as obviously the big show they made a couple of weeks ago, of course, with Modi and Kim Jong-un, for that matter, and Putin there as well. And I am curious as to what is China's strength in these talks going forward?
So I think one of the surprising things remain, certainly surprising to many here in Washington, D.C., is quite how punchy China has been since Trump started his second term. Trump moved tariffs really high, expecting China to fold. They didn't fold. They retaliated with sky-high tariffs themselves. The U.S. moved ahead with controls on semiconductors, expecting China to fold. China didn't fold. They responded with their own controls on rare earths. And now here we are with Treasury Secretary Bessent and Trade Representative Greer meeting with China's Vice Premier He Lifeng in Madrid. And I think the expectation here in D.C. was, well, we're going to get some concessions from China so they can keep TikTok active in the United States. But we didn't get concessions, or at least we haven't heard about them yet. Instead, we got this antitrust ruling against NVIDIA. So on tariffs, on rare earths, on flexing their own regulations and anti-monopoly laws, I think we've seen a surprisingly robust response from Beijing, certainly no folding in the face of escalating U.S. pressure.
Well, Tom, we have to quickly talk a little bit more about TikTok, because you mentioned, of course, we have this high-stakes negotiation going on in Madrid right now, but apparently President Donald Trump and Chinese President Xi Jinping are due to speak on Friday specifically about TikTok, this framework that the U.S. says that it has met. Trump posting on Truth Social that I will be speaking to President Xi on Friday. The relationship remains a very strong one, and then 3 exclamation points. So somehow TikTok, it feels like, has become an integral part of what's going on this week when it comes to these high-level discussions.
Yeah, or maybe instead of speaking to each other, they could just both record their own TikTok messages with dances and send them over to underscore the importance of the app to the continued bilateral relationship. But more seriously, I think there's a couple of striking things here. The first is the US is playing catch up, right? China, well, they blocked Meta, they blocked Twitter, they blocked Google more than a decade ago because they recognized this intersection between technology and data security and national security. So this US discussion on TikTok is really Washington, D.C. playing catch-up with Beijing a decade later. The second thing is, whilst we've got Bessent saying there's a framework for consensus here, the details are very much to be decided, as is the reality or otherwise of this Trump-Xi call. We'll be paying close attention in the days ahead.
Tom Orlik, our chief economist over at Bloomberg Economics, a closer look here at, I guess, the tensions and maybe potential lack of tensions between the U.S. and China.
I mean, he used 3 exclamation points. I don't even use that for happy birthday wishes.
I know. You didn't send me a happy birthday wish this year, but there's always next year. When we come back, we're going to talk Union Pacific. The shares moving slightly higher on the day, an upgrade over at CITI, and maybe a little bit more clarity on that merger with Norfolk Southern. That conversation coming up after the break. This is The Close on Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off with MongoDB. Wedbush raising its price target on the software company to $400 from $300, maintaining an outperform rating. Dan Ives, the analyst over there, saying the company is now on his best ideas list now that the, quote, growth story has started to regain momentum. Those shares up about 1% on their day to the highest levels, actually, of the year. Next up, CoreWeave. Deutsche Bank putting a near-term buy on the cloud computing company, holding the price target at $125. The firm says demand for AI infrastructure appears insatiable. Despite some of the long-term uncertainty, a 7% pop on the shares to the highest level since August. And finally, let's take a look at Union Pacific. CITI upgrading the railroad company to buy. The analyst says increased clarity on the merger with Norfolk Southern and a risk-reward that's too compelling to ignore are reasons behind the upgrade. A modest bump in the shares on the day to 216 and change, and those are some of our top calls. We do want to stay on that last call because the analyst behind it joins us right now. Ariel Rosa is senior analyst of equity research over at CITI, a $72 billion merger that I think when we first heard about it, a lot of people said, no way this thing is getting through. It's a much different regulatory climate right now. You think this is pretty much a done deal?
Exactly as you said, the regulatory environment has really changed a lot in the last 6 months or so, right? And so this went from a deal where nobody thought it was possible. We've gone 25 years effectively with no big rail mergers except for one, right? And that was kind of the 2 smallest ones, so it kind of made more sense. Here you're dealing with 2 real behemoths that nobody thought it was possible, but Trump has kind of come in and changed the climate around M&A and around big deals. And so now it increasingly looks likely. We put a kind of 65 to 70% likelihood of the deal going through. The real question for us, at least, is what are the constraints or what are the conditions that are going to be put on the railroad if they do get merger approval?
What does, let's assume this deal does go to completion here. What does a Norfolk Southern Union Pacific mashup mean for the bottom line? Is this going to be a volume story? Is this going to be a pricing power story? What is the net advantage when this is all done?
So it's a bit of both is the reality, right? So the company has gone out and put out a target for $2.75 billion of synergies, 1.75 coming from revenue, $1 billion of cost synergies. They've said, that'll be achieved over the course of 3 years, but you're really talking about a pretty massive uplift in free cash flow. So the company is saying that they think they can get to $12 billion of free cash flow by 2029. We did some math on this over the weekend. We said, look, currently Union Pacific is earning about $11.50. $11.65 is actually our target for this year. And we think they can get over $17 by 2029. So you're talking about a pretty big uplift in EPS. And then also what we've seen is these types of big industrial conglomerates, right, really high quality industrial assets tend to trade at a premium as well. So you probably are talking about a multiple bump as well. And so to us, that gets you somewhere in the neighborhood of potentially $350, $360 a share versus where it's trading right now, which you can see on the screen is, quite a bit of upside. We discounted that back and we said kind of somewhere in the kind of 250 to 270 range probably is fair value for this company.
Let's talk a little bit more about that chart, because listening to you speak now, reading the note that you put out over the weekend, you're right, UNP executing at a really high level, and as the chart shows, the stock is cheap. So what is the broader market missing about this message? Why are shares actually lower on the year and really for the past 5 years just trading sideways?
It's a great point, Katie. It's really a couple of things, right? So first off, the company has said, and with these mergers, it's always complicated, right? And so the merger probably doesn't close until 2027. Given that, I think there are a lot of investors who kind of want to wait, see how things play out. And so that's just kind of a reality that we have to deal with. The timeline there is there's a lot of uncertainty between now and 2027. So that's first. The second, really the second factor is just that for the company, transports broadly, frankly, have been out of favor. Sentiment has been really negative. To your point, the stock is cheap, and we've been saying, look, if you look at the largest companies in the industrials sector, the industrials ETF, Union Pacific has the highest free cash flow yield. It has one of the lowest PE ratios, and it has some of the highest operating margins in that group. And so you're talking about a really high quality business, but a lot of people are put off by that timeline to close.
And we don't have a lot of time left, but I do want to talk about the rest of the landscape here, because one of the big questions out there is, okay, who's next? I know that you recently wrote about CSX. There's possibilities that some activist investors could force a sale there. I mean, when we talk about more real M&A, it seems like reading your coverage that this isn't the way to make it happen. So
the real challenge with CSX getting acquired is that the most logical buyer is BNSF, which is, of course, owned by Berkshire Hathaway. And Warren Buffett seems to be indicating that he's not interested right now in doing a deal. So I've pointed this out to a lot of folks. You're not going to force Buffett into doing a deal or submitting a bid. And it would actually be the largest deal that Buffett has ever done in his career. So it's really an obstacle. That said, if UPNS goes through, we think it's likely eventually that BNSF and CSX will merge. But it could take some time. And I think, frankly, from Buffett's seat, my guess is, A, he seems to be a little bit concerned about macro risk and how did the tariffs play out. And then also he seems to be concerned about watching how the regulatory process unfolds. Right. And then getting that certainty and then moving forward. All right, Ariel, got to leave it there. Such an interesting conversation. That is Ariel Rosa. He is Senior Analyst of Equity Research over at CITI, talking about rail M&A. Now, coming up, we'll speak to Thomas Peterffy. He is the chairman of Interactive Brokers, to get his current market outlook and the competitive landscape for online brokers right now. That conversation up next. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. Just 30 minutes to go until those bells ring. Looking at yet another rally. I thought September was supposed to be scary.
I know. That's what that's what the data told us, right? The historical data. This is supposed to be one of the worst months. But, so far, 15 days into it, basically halfway through it here, it's looking pretty good. Record high after record high after record high.
You know what could change things?
Uh-oh.
Jerome Powell, of course. We are barreling towards that Fed decision. It's a fun thought exercise, right? To think what could derail this equity rally. And if we did get that mythical 50 basis point cut, how would they message it in a way that doesn't freak people out?
I do kind of wonder what's going to happen on Wednesday, because this has been the most telegraphed rate cut that we've had in quite some time. Everyone's expecting it. So what happens? Does it become a sell the news event? Are people just going to be so disappointed if he just cuts 25 basis points?
Yeah, that seems to be the fear that's creeping into the market, especially as you mentioned, we get record high after record high. Could shape up to be a sell the news event, but a lot to get through before we get there.
My Oura ring tells me my heart is pulsating right now.
Take a deep breath. We still have 2 days to go, of course, counting down to that Fed decision. But we're also taking a look at how folks are actually investing in the market, the ways that they're accessing, of course, the public equity markets and the private markets, because Robinhood is launching a new fund to give U.S. retail investors exposure to private companies. Pending SEC approval, the fund will be available to investors via brokerages such as Robinhood and its competitors. further heating up competition in the online brokerage space. So let's discuss that now with Thomas Peterffy. He is chairman of Interactive Brokers. Great to have you with us. And I think about how fierce the competition is when it comes to online brokerages. You have Robinhood rolling out new products by the week. You have online brokers such as eToro and Webull going public recently as well. What's your read from where you sit as chairman of Interactive Brokers, and how do you keep up?
Well, competition has been very strong for the past 40 years since we've been in this business. So that's nothing new. It's the same thing every day. You have to come up with new products and new services, and yeah, people demand that, yes. And we are doing that.
Well, to that point, and we're going to speak about prediction markets in a minute, which is one of the things that you're doing. But when it comes to private markets, when it comes to private companies, that certainly seems to be the investing flavor of the week, flavor of the year, whatever you want to call it. Do you have any plans to open up retail access, retail investor access to private companies?
Well, that is, we have been looking at that for quite some time. It's a complicated area because don't forget, whenever something goes wrong, when somebody loses money, people are looking at the big pocket and they sue the brokers. So, you know, we have to think about that.
So when we talk about, though, the idea here of how your business has expanded, and more importantly, the idea of how investment has expanded, Thomas, I am curious about the idea that the traditional ways of investing have shifted. It's not just buying the stock or buying the bond or even buying the option. It's tokenization, securitization, prediction markets, et cetera. How do you fit in?
So I think prediction markets are an incredibly important development. And I think they are going to become more and more and more important to the point where they will overshadow the equity markets. So, because you see, if you have to look at it this way, so it's not about, you know, football games and predicting, you know, the outcome of whether some star is going to get married or not. It's about the socioeconomic environment that we will be in 5 to 10 years from now. So all businesses and institutions and individuals have to plan for their future. And those plans have to be in sync with the environment at that future time. And so far we had no way of seeing into the future and hedging against an adverse development. So these prediction markets give you a way to see the consensus, to constantly monitor it, to hedge if you have a different view, and to profit from undervalued contracts.
Do you think, though, I am curious, to a certain extent, isn't that kind of what financial markets have always done? I mean, the idea that the stock market is supposed to be an indicator of what people think future earnings will be for corporate America.
Absolutely, but it is a slim segment of the future when you look at the price of any one stock. So when I think you have to have a more global and a more full view of the future in order to really be able to perfectly plan any business or any individual career.
Well, Thomas, let's talk about the future a little bit more. I thought it was really interesting to hear you say that you think prediction markets could overshadow equity markets. You think about where we could go. It feels like the lines between gambling, prediction markets, and investing, such as in public equity markets, that those lines are increasingly being blurred. And I just wonder, is that a line that should be blurred? And is it perhaps inevitable that it will be?
It will be blurred, but when you talk about gambling, it depends on what question you're looking at. I mean, yes, if you're looking at whether a certain team is going to win over another team, that is gambling. But if you're looking at questions having to do, for example, with the national debt 10 years down the road, that is a more important question. And I think we should all seriously consider that question.
Well, how, with regards to the prediction markets on that side, though, I mean, how honest do you think that those bets will be? Because at least if you're investing in a stock or a bond, there is sort of a material exposure you have to that outcome. Is the just predicting whatever binary outcome might happen for the economy or whatever, does that still have sort of the same sort of exposure for the person making that bet?
Absolutely. If you bet the wrong way, you lose your money. And if you bet the right way, you make money. It's just the same as the markets, right? The equity markets or commodity markets, or it's not different. But I think that for serious analytical investors, I think prediction markets will be a very, very important outlet.
All right, we have to leave it there. Always a great conversation. Thomas Peterffy there, the chairman of Interactive Brokers. And Katie, of course, I think he kind of hit a really salient point here about kind of this is the future, whether you like it or not, whether you think it's a good thing or not. Everyone seems to be moving in this direction, a broader embrace of prediction markets, tokenization, other things that, at least in his view, are going to give people, I guess, a little bit more of an accurate way of making bets.
Absolutely. The line's blurring. And of course, from where he's sitting as chairman of Interactive Brokers, where all these other online brokerage are sitting as well, you have to go to where the puck is going. And it seems like prediction markets increasingly, at least from investor choice standpoint, seem to be the future. I will point out, you take a look at shares of Interactive Brokers, absolutely crushing it this year, up 42% on a total return basis. So also probably the anticipation of being added to the S&P 500 help.
Well, that and, of course, all the market volatility here, you would hope they would be crushing it. You know who else is crushing it?
Tell me.
Alphabet.
Oof.
The share is up 4% today and now crossing the $3 trillion mark. We're going to talk about what this means for Alphabet, now joining a very exclusive club. It's our stock of the hour, and it's coming up next here on The Close. This is Bloomberg. All right, time now for our stock of the hour, and we're taking a closer look at shares of Alphabet. A 4% pop in the stock takes it above a market value of $3 trillion. Analysts saying the faster product development, Gemini adoption, and better regulatory clarity can maybe even drive the stock even higher. Mandeep Singh joins us right now, global head of technology research for Bloomberg Intelligence. We should point out, prior to today, you only had, 3 stocks with a $3 trillion market cap, NVIDIA, Apple, and of course, Microsoft. All right, so Alphabet joins it. Look, I know we make a big deal out of these round numbers, but this has been obviously a juggernaut of a company for years now. But it does raise a question. A company of this size, this maturity, how do you sort of keep that momentum going?
I mean, I think the whole DOJ case was a big overhang in terms of the valuation multiple. And since then, the fact that they keep all their assets intact, they can still have a partnership with Apple, I think that is the catalyst that's propping this up. And look, when you look at all their businesses, cloud, YouTube, I mean, cloud business could actually double over the next 2 years. And I think the Oracle backlog number was a good illustration of what these hyperscalers could do in terms of their cloud growth. So to my mind, if the search business is intact and cloud grows and YouTube grows, I mean, $3 trillion is, I think, very normal.
Are you calling the $6 trillion now?
I would be surprised
if
they keep going up from here.
Well, I was joking in the commercial break, but I don't know if it's a joke that after NVIDIA hit $4 trillion, $3 trillion seems a little bit quaint here. I know they're in rarefied air. They have, good company when it comes to the other companies that have market caps above $3 trillion. But realistically, if all of those things that you mentioned come to fruition, especially when it comes to the cloud business, I mean, is $4 trillion attainable? Is Romain Bossic's $6 trillion attainable?
So the one anecdote that Alphabet has shared that no one else has shared is the tokens per month. And it's a pretty big number. Google does 980 trillion tokens per month. That's grown 10x over the last 12 months. So imagine if you're in the business of Gen AI and your consumption has gone up 10x across your family of apps and products. That just goes to show that Google products are being used for generative AI. Even OpenAI doesn't have that sort of growth, albeit a much smaller base. So to my mind, that's the one metric that everyone should care about because it shows their Gen AI lead.
All right, got to keep an eye on those tokens. Mandeep Singh breaking down what you need to know. Mandeep Singh.
Do you know what tokens are, Katie? Or are you just?
I have it on my note to Google after the show. Google, which is of course good.
Put that
for
in Gemini and see what it has to say.
Right, just figure out what that is. Anyway, it's going to be interesting, of course, to see if we actually get to some of those figures when it comes to Alphabet. But for right now, we're skating ever closer to that closing bell on this Monday, this pre-Fed Monday. We'll take you to the closing bell with Winnie Cisar. She is Global Head of Strategy over at CreditSights. That conversation up next. This is The Close on Bloomberg.
I think it's going to be a 25 basis point cut and a lot of data dependency after that. Listen, I don't think we've seen the full effect of tariffs yet, nor, most importantly, how it's ultimately going to affect inflation. And so I think the Fed's going to have to be on wait and see mode, and the market may be disappointed by that.
Mike Contopoulos over at Richard Bernstein Advisors kicking us off to the close just about 50 minutes ago. And with 10 minutes to go, Katie, it looks like we're setting up for another record high for U.S. equities.
Absolutely. Green on the screen. And you can see the S&P 500 up about 0.4%. Breadth pretty decent today, but it's big tech in charge. The NASDAQ 100 higher by about 0.7%. You do have volatility coming back into this market, at least by measured by the VIX. So stocks up, vol up, still trading with a 15 handle, getting closer
I wonder
to
what's
16.
behind that. You think that's because of some uncertainty about kind of what happens post-Fed,
I would love to know, because
Yeah.
it's rare. It feels rare to see the VIX actually rise. It feels like volatility has just been draining out of this equity market. A little bit of a bid coming into the bond market as well, at least when it comes to the long end of the Treasury curve. We've been hanging out around 4%, though.
Yeah, a lot of people talking about this Fed meeting, which kicks off tomorrow, concludes on Wednesday, as a bit of an inflection point for the markets, whether it's in equities or in bonds or elsewhere. Let's get some insights right now out of Winnie Cisar, Global Head of Strategy at CreditSights. And Winnie, I do want to start off with the Fed, and more importantly, what it's going to tell us about kind of the state of the economy. And you're great because you know what's going on in the credit space right now. Credit spreads are about as tight as they've been, at least in the post-financial crisis era, which, as an economic signal, which seemed to say that investors aren't too worried about the economy. So why are we cutting rates?
That's a great question, Romain. Thank you for having me. So cutting rates, I think the labor market seems like it's maybe gotten away from us a little bit. Coming into this year, we thought there were going to be some cross currents really impacting that unemployment rate, right? If we have different policies that are causing perhaps people to drop out of the participation factor, then unemployment's going to be a bit sticky. What we've seen is this major downshift in job ads, and then the concentration of sectors is pretty narrow in terms of where those jobs have been added. And if you look back historically to, a 30,000 per month job ad gain, which is kind of where we're averaging on a 3-month, that's historically coincident with job ads really kind of dropping off or potentially going negative. So I think the Fed is really focused on that labor mandate right now.
When we talk about the start of a rate cutting cycle, not just a one-off in September here, what does that look like to you? Are we talking, the 3 cuts and the market's priced in for 2025 plus another 2 or 3 in 2026?
Sure. So we actually think that the Fed might be a little bit behind the curve here. Had we known about the July data on the payroll side of things with the July meeting, maybe the Fed would have cut 25 basis points then. And so we've been saying it's maybe a toss-up between 25 or 50 at the meeting this week. Probably 25, just given where inflation came in last week, but we think 50 could still be on the table. Now, where we go from here, the Fed's in a really sticky situation. Inflation does have some factors that may have some supporting kind of re-acceleration trends underpinning it. But we do know that margins are coming under some pressure. The labor market has come under some pressure. And that seems like kind of a stagnation, stagflation-light type outcome.
Well, bringing that back to the corporate credit market, I'm taking a look at your notes, and you write that we are not expecting fundamentals in aggregate to materially improve going forward and see the potential for ratings downgrades to outpace upgrades over the next 12 months. It feels like we haven't been in that dynamic for a while. So is that something that a true rate cutting cycle can fix at this juncture?
That's a really great question. So, thinking back to where we've come from, we've been through a massive ratings upgrade cycle, and we've seen really strong deleveraging of corporate balance sheets. Now we're seeing a lot of headlines around events, right? We're seeing more M&A, more spin-offs, all of these different things, which are oftentimes intentionally releveraging, predicated on, cost savings and synergies and all of these things kind of going right, while at the same time, we still have a wild mix of policy and economic factors. And so as we think about kind of where valuations are, they're perhaps reflecting what balance sheets looked like in 2024, which was very, very strong, but maybe less so 2026.
Yeah, well, if that's the case and that's your base case, what do you do in that environment? Is this a short duration, high quality sort of setup here?
Yeah, so we've been telling investors, if you are a yield-focused investor, U.S. investment grade still feels okay. We've been more constructive on duration within the Treasury market at the longer part of the curve, the 10-year part of the curve, the 30-year part of the curve. Now, if you're more focused on that spread component, on excess returns, you really have to be aligned with sectors and issuers where there still are positive catalysts. And there are still some. We still have some rising star upgrades, perhaps in the cruise space. We still have positive event risk, even in the high yield sectors of telecom and media, as we've seen a pretty significant net positive regulatory change. And so there are definitely places to go, but you want to have a specific fundamental catalyst that you can kind of pinpoint over the next 12 months in mind.
Now, how do you, if at all, price in kind of the, geopolitical risk, for lack of a better phrase? I mean, we spent the first few months of the year just obsessing over everything coming out of Washington and, of course, our relationships with China and seemingly every other country. Is that something that needs to be priced in?
I think it's something that needs to be respected, and you need to be aware of it. But it's oftentimes really hard to price in that tail risk downside. And in fact, I think at this point, there are some sneaky geopolitical positives that could materialize that may catch people off sides. What happens ultimately with tariffs and trade negotiations? What happens with administration intervention into specific companies? That's actually been kind of a net positive in some of the companies that we've been following. And so you do really have to proactively focus on some of the positives without just discounting all of those negatives.
So, and that's a good point. And we've heard a lot of people sort of start to bring that up, economists too, for once. There's the issue of, sort of the independence and the integrity of our agencies, whether it's BLS. And of course, we know one way or another there's going to be some big changes at the Fed over the next few months, assuming that we actually make it to the end.
Yes, absolutely. And that's one of the things that we're really focused on. When we talk to investors outside the U.S., though, it is interesting. They still view the U.S. as kind of the least worst place to be. It's still a very liquid market. There's still regulation. There's still well-known issuers aligned to U.S. fundamentals. And so that massive just kind of knee-jerk, we're going to sell everything U.S. if I'm outside the U.S. hasn't really materialized. And I'm still a believer that, we'll eventually get it together from an institutional credibility standpoint.
You're not out buying Rheinmetall bonds or anything like that. So, Winnie Cisar, Global Head of Strategy over at CreditSights, some great insights here as a setup into that Fed meeting here that could be the most consequential Fed meeting ever, or just a kind of nothing burger. We expected it. Let's move on.
I like to make the joke that every Fed day is the most consequential Fed day, the best day of our lives. This one is particularly interesting, though.
Do you think Jay Powell, when he wakes up on Tuesday morning, looks in the mirror and says, "This is it.
Can't imagine.
This is my day."
Imagine he takes a cold, hard look in the mirror and says, "I cannot wait until May."
Does his best Stuart Smalling impression, and just anyway. But in all seriousness, this is a market that really does seem to be taken in its stride, Katie. Record highs right now for both the NASDAQ and the S&P.
Absolutely. That 25 basis points seemed like a lot, at least looking at this market.
Alphabet, Tesla, Microsoft, Apple, Amazon, all your favorites leading the board here on this Monday afternoon. A full breakdown starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld, taking you through to that closing bell with a global simulcast. It starts now. Carol Massar and Tim Stenovic. There's Carol in the radio booth. Welcome to our audiences across all of our audience. Here. I know she just turns around like she's surprised. We do this at the same time every day, Carol Massar.
Yeah, but this day is different.
Wait, who's there?
This day is different.
What's different?
Could you say happy anniversary to Carol?
Happy anniversary. What's your anniversary? Your wedding anniversary?
Yeah, it is my wedding anniversary.
All right.
Congratulations.
Well, congratulations.
Thank you very much.
Okay.
Yeah.
Okay.
I hope he's watching right now.
Yeah.
No, he's not.
Okay. Wow. There you go.
But he did, the important things he's good about.
All right. Well, look what he's missing.
Turns it off during the simulcast.
Green on across the screen, Carol Massar.
Yeah, I mean, I don't know, bouncing around here, but you're right. We have equities, so investors moving into both equities and bonds today. This as we get ready for that Wednesday Fed decision. There's a lot coming out. We have a bunch of central bank meetings this week.
We do. Not green across the screen, though, if you look at what's happening with airlines. You got Delta lower, American Airlines lower, United Airlines all lower. Alaska came out and said third quarter profit will be at the low end of their previous estimate. That's weighing on airlines today.
Absolutely. So still some red if you really look for it. But overall, it just seems like we are setting up for Wednesday. Romain and I have been discussing whether or not, given that we hit record high after record high, whether this could turn into a sell the news event. That could be the question to ask. But right now, again, green on the screen.
We actually asked that of Brent Schutte, who was just on with us, talking about the markets, and he thinks a lot of it's already priced in.
Yeah, it does appear so. We'll find out, of course, in about 48 hours or so as we close out the bells here on this Monday afternoon. It is green for the major indices here in the U.S., and more importantly for the S&P and NASDAQ. Record highs. The S&P up about 0.5% on the day to that 66.15 level. The NASDAQ composite up about 200 points or almost 1%. Similar move higher for the NASDAQ 100. The Dow Jones Industrial Average adding about 50 points or 0.1%, while the Russell 2000 is up by about 8 points or 0.3%.
All right, good stuff. S&P 500, you've got actually, despite a fair amount of green on the screen, 302 names in the S&P 500. Katie, losing ground today, 199 to the upside, 2 unchanged.
Well, let's see what the circle says about that. At the sector level, you do have some pretty important sectors in the green right now. Tech, of course, chief among them. Communication services also having a really strong day. A lot of that comes back to Alphabet, which I'm sure we'll discuss. Then you take a look at what isn't doing too hot. Consumer staples lower by more than 1%. Healthcare also getting sold off today. So more red than green, at least taking a look at the sector breakdown, but you can see what is green on the circle definitely looks good.
Yeah, pretty dominant there. Let's get to some of the individual gainers.
Hey, Carol, did you know that William Taft, former president, was actually born on your wedding anniversary?
Wow.
I did not know that.
Yeah, there you go.
That wasn't the deciding factor in the date?
Yeah, that's exactly it. What we were talking about when we would get married. News you can use. All right, Tesla, top gainer in the S&P and NASDAQ 100 throughout the day. Nothing like the ultimate insider, Tesla insider buying shares. You guys all know the story. Elon Musk kind of responding to that unprecedented proposal in terms of the Tesla board, the pay proposal of $1 trillion, Of course, there are some conditions around it, but nonetheless, Elon bought about $1 billion worth of shares. So it sent shares of Tesla soaring up as much as 7.5% in today's session, finishing, though, with about a 3.6% gain in today's session. He bought them indirectly, a revocable trust, revocable, Is that the way you say it? What am I saying? Is it right?
I'm not a lawyer.
That's one of those words that I read and I don't say
revocable.
out loud.
Is it revocable?
Yeah.
Didn't sound right when it came out. Okay. He did that on September 12th, according to regulatory filing. What we really care about.
Hey, Carol Massar, did you know that Agatha Christie was also born on this day in history?
Oh,
come back to us, Romain.
Okay.
Come back to us. All right, let's get
I thought
to
you needed a moment to
Kate. I always need a moment. Katie mentioned Alphabet, and that stock up about 4.5% in today's session. Yes, finishing with that $3 trillion market cap. So joining NVIDIA, Microsoft, and Apple, that $3 trillion market cap club. So we definitely see Alphabet go into it. This stock, a top gainer in the NASDAQ 100. And we should point out that CITI raised its price target also on the Google parent to $280 from $225, noting, yes, competition facing the company's search business, but also noting greater clarity around the Alphabet story when it comes to legal and regulatory challenges. And they just think there's also a healthy online advertising market. So all in on Alphabet today. And then CoreWeave, definitely an outperformer, up 7.6% in today's session. And that one, the cloud computing provider, went public, of course, this year, saying its shareholder NVIDIA will buy cloud services with an initial value of $6.3 billion. It's all part of a deal that was announced a few years ago, but it requires NVIDIA to buy any excess capacity not used by its customers. So CoreWeave putting that out in a regulatory filing. Anything else about September 15th that I need to know, Romain?
Yeah, I've got a couple. I'm just waiting for the right time to interject.
Okay.
Okay.
Take it away, Tim.
I'll start with some decliners. This was the worst performer on a percentage basis in the S&P 500. Corteva today down 5.7%, falling the most intraday going back to April of this year. Wall Street analysts find a potential breakup of the company's seed and pesticide businesses negative for the firm. Bloomberg Intelligence says a breakup undermines product and financial logic. Bank of America says a separation would create two weaker entities. You remember the report that we talked about here on Friday from the Wall Street Journal said that the seed and pesticide company is looking into separating into two companies. They cited two people familiar with the matter. Hain Celestial down 25% today, lost a quarter of its value. This after the company posted fiscal fourth quarter results and revealed sales fell 13%. Management provided disappointing first quarter guidance. You know, this was only the worst day going back to May. That was when it fell 47% in a single day. Stock is down 74% so far this year, and at one point today it hit its lowest level in more than 30 years, going back to 1994.
What's going on with this? I remember like when I was younger, I used to always, all their teas that they had.
Yeah.
You know, it was kind of like a staple in our house. But
Celestial Seasoning is the tea. They also have Garden of Eden chips. I'm a big fan of the Red Hot Blues.
Yeah, I like those too. Yeah.
Those are good. Earth's Best with baby formula, baby food and stuff. Okay, so it's a pretty diversified portfolio, but they've been under pressure for quite a while.
There's a lot of choices out there now.
Yes.
Phil, right?
Yeah, there are a lot of choices.
You can't even buy a box probably of Hain Celestial. Like you could either like the share
What do you mean?
price.
What do you mean you can't buy a box?
I mean, like,
have you been in a grocery store lately?
Well, my point is, like, a share of their stock is cheaper than probably a box of tea.
Oh, I got you.
Sorry.
Okay.
I jumped ahead a little bit.
Like drink some deadly tea.
$1.62, is that right? Yeah, okay. I'm just looking up at the screen. VF Corp, also under some pressure today. The stock fell today just by about 1% at the end of the day. Intraday it was down more. The company said it'll sell Dickies to brand management firm Blue Star Alliance for $600 million in cash. They bought Dickies 8 years ago for $820 million. The company's CEO said that the sale will enable VF to bring the company's net debt level down.
Hey, I just want to chime in here, add a sort of honorable mention, a small cap stock moving in the after hours trade. Dave & Buster's ticker play down as much as 10%. They're reporting earnings, and it looks like a big miss here. Second quarter adjusted EPS coming in at 40 cents a share. The street was looking for 90 cents. So a big miss on that front. On the revenue side, a modest miss of about $557 million. Overall, though, comp sales down about 3%. And of course, a lot of people really trying to get a read here on what's going on in the economy, whether we're still spending, and more importantly, whether we are still spending on discretionary items. We'll keep an eye on that space and bring you any updates as soon as we get them. Just a quick check on yields, guys. We did see the Treasury curve shift lower here once again here on the day. A lot of folks, of course, really trying to reposition or simply position around the big Fed decision, which comes on Wednesday afternoon.
Yeah, looking forward to that. Of course, we talk about how much is priced in when it comes to the equity market. You have to wonder how much is priced in when it comes to the bond market. But maybe we should talk about some interesting news out of the Vatican. I know that this caught your attention. Apparently, the Pope was asked about Elon Musk's proposed $1 trillion pay package. And
we should point out a Chicagoan, but go on.
Right. First American Pope. It's all very exciting. He said that this basically is going to be big trouble. He was talking about the growing income divide. This was during an interview with The Crux that was released on his 70th birthday, which I believe was over the weekend. So it's interesting to hear the Pope weigh in at all, I would say.
You know, as a big fan of the Pope, as a Chicagoan and as a fellow Catholic, big fan. Why is he weighing in on this? I mean, I know he gets to talk about whatever he wants to talk about, but
it wasn't like he got on the horn, I think, and just broadcast his opinion. It was in an interview. He was asked about it.
We're not going to see him at the shareholder meeting in a few weeks,
awesome.
raising his hand.
He's got a new podcast.
Would there be a special Tesla Pope mobile?
That is a good question. Maybe he'll be asked about that next. You do mention he's from Chicago. He also went to Villanova University, which is right down the street from Haverford.
You do not get to claim him, Katie. He's a Chicagoan.
I'm really trying
we got some breaking news here, guys. On Disney and Webtoon. Webtoon shares up 34% right now in the after-hours trade. This after learning that Disney has acquired a 2% stake in Webtoon Entertainment. If you're not familiar with it, talk to your kids here. But basically now saying that this new platform combined with Disney will host 35,000 of the comic series from Webtoon. A huge boon for Webtoon here. Disney shares not doing a whole lot.
Yeah, I mean, Webtoon was up about 10% year to date, but you're right, Romain. It's up almost 50% here in the aftermarket, so certainly catching our attention. About a $1.9 billion market cap.
It is. I will point out, we spoke with David Lee just a few weeks ago. He's the CFO and COO of Webtoon. Check out that interview if you did miss it.
Yeah.
Nice plug.
Yeah.
Nice plug.
Just, you know.
Wait, can we flip our hair on that
you're
one?
welcome to come back too and join us on this deal as well.
Wow.
Always be selling, you know.
Always be selling.
Always be closing.
What about Bob Iger? Did you have him?
We gotta. You're breaking up, Romain. You're breaking up.
Well done. All right, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Folks, we will see you again, same time, same place tomorrow. Katie and Romain continuing there on TV. Tim and I right here on Bloomberg Business Week Daily.
And Katie and Romain do continue here on Bloomberg Television. We're going to talk a little bit more about Elon Musk, that $1 billion purchase of shares, that potentially $1 trillion pay package, and more importantly, really, about where Tesla goes from here. Jon McNeill going to be joining us in just a bit. He's the co-founder of DVx Ventures and the former president of Tesla. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic. More than $10 trillion has been added to the NASDAQ 100 since that April low. More than $14 trillion added to the S&P 500, and those gains continued here on this Monday afternoon. Both the NASDAQ 100 and the S&P 500 closing out at record highs, the prelude potentially to a big Fed meeting that kicks off on Tuesday. A Fed decides decision on Wednesday, and a lot of questions as to whether a rate cut, and more importantly, whatever telegraph we get out of the Fed, might provide a little bit more fire to the rally. Gold stocks as a group rallying again here on this Monday afternoon as a group at a record high, and keep an eye on yields. The repositioning now starts ahead of that big Fed meeting.
Well, as we count down to Wednesday's decision, let's take a look at what's moving underneath the hood of this equity market. I threw up Alaska Air because we heard from the airline today saying that quarterly profit will be hit by fuel costs, among other things, dragging down shares of Alaska Air, also dragging down some of the other airlines. That was the bad news. We got a lot of good news when it comes to the mega caps, starting with Alphabet crossing $3 trillion in market cap, shares up more than 4% to lift us there. And of course, Tesla shares up 3.6%. And let me tell you why. That brings us to our top story. I'm going to walk over here to tell you about it. I learned that last week. We saw that surge in tech megacaps driving the S&P 500, led by Elon Musk purchasing about $1 billion worth of Tesla shares, a real vote of confidence following the board's recent pay proposal. As such, you saw Tesla erasing its 2025 losses on the back of the move. And since early April, Romain, that is a 45% drive here, now back in the green when it comes to Tesla, one of really the only bad spots when it comes to Magnificent Seven this year.
Absolutely. Here, let's get some insights out of Jon McNeill. He's the former president of Tesla, now the co-founder of DVx Ventures and of Vista Shares, and I should point out, a fellow Northwestern University alum. That in and of itself always gets you an invite on this program, John. But I do want to start off here with kind of the future of Tesla. And I want to go back to an interview that we had last week with the board chair over at Tesla, who kind of made the case that, at least in her view, in terms of leading this company forward, sort of taking it to that next level, that Musk, in her view, is basically the only guy that can do it, and that in and of itself justifies that potential pay package. I am curious about the path forward, though, and whether you think that Musk as CEO is the right person for that. Not that he shouldn't be part of the company, but as CEO.
Well, he's making a big bet, obviously, on the future. If you look at the value of Tesla stock from an investor standpoint, of course, it's hard to value it on the fundamentals. You've got a car business that's losing share, losing cash flow, and losing brand position. And it's really a function of two things. It's got a tired lineup, and it's got a CEO reputation issue that I think even the Tesla folks recognize. But the bet he is making is that's not the future play. And as an investor, you look at their balance sheet, and they've got roughly $30 billion of cash on their balance sheet. And they're pointing to a future, and he's pointing to a future of robotics and self-driving cars and robotaxi. Both of those things are AI. So basically pointing to a future of AI, and the two products are going to be robotaxis and robots. And what you got to believe as an investor is that $30 billion cash pile gets you to the other side. Because there's not going to be much cash flow coming off of the car business, especially given that the credit regime has totally changed where other car manufacturers don't have to buy credits.
I am curious, though, about the idea of the starting point, because when you go back to Tesla's past, one advantage that Tesla had, because it was kind of the only game in town, if you wanted an EV or at least a reliable one with reliable range, let's face it, there was a multi-year period where that was pretty much the only game in town. Even when you talk about robotics, AI, there are so many legitimate players in this space already. And I do wonder if that puts Tesla, with or without Elon Musk, at a disadvantage.
I think, Jensen Huang said it correctly. There's only one guy on the planet that he knows that has put together a cluster, an AI cluster the size that Elon has put together in the time he's put together. So not only fast, but the largest size, and now they're building the second. So I think from a Tesla perspective and from a board perspective, they're betting on Elon as the person that brings them into the robotics and AI space. He is especially skilled to do that. OpenAI was essentially founded inside one of the Tesla conference rooms. So he's been at this a while, and he's demonstrated a skill set that is at or above his peer level. Grok, which was just released by xAI, has some of the highest scores of any model, and most importantly, on the code development side. So you're getting, in exchange for this pay package, a super talented executive. And I think that's the argument that they're making.
Well, just to come back and to really crystallize the point of whether or not Elon Musk is the person to lead this company to the next phase, John, just to draw a line under what we're talking about, I guess it depends on what Tesla actually is. You mentioned all of the sort of traditional car company problems that they're dealing with, EV saturation, whether or not they can continue to defend their market share. Perhaps that's something that a traditional car executive would be equipped to deal with. But if the future of Tesla really is robotics, if it really is AI and these self-driving cars, then maybe you do want an executive like Elon Musk.
I think that's right. And it may be both and, Katie. It may be that you've got a future robotics company and you need Elon to lead that. They may at some point, I wouldn't be surprised if they decide that the car business isn't essential to that, and they may look to redeploy that asset and potentially even sell it, and so that it's managed like a manufacturer, and that's one, I think, option that's on the table. But clearly, with the stock price being up, the CFO's got to be thinking about issuing shares and adding to that cash balance so that they've got the ability to make it through to the future.
And I do want to point out this line in your notes because I think it's really true to what we're talking about right now. When your customers are arguing about your CEO instead of talking about your product, you have a problem. And this ties into, of course, where we were at the beginning through the midpoint of the year, Elon Musk being heavily involved in the Trump administration. And I remember the conversation at the time was whether or not this is doing sort of brand damage that you can't undo to Tesla. And John, sitting here in mid-September, where do you fall on that question?
I think with a CEO of a product company, you've got to be in just 100% of your time almost is spent on the quality of that product and on the quality of the future product and your future plans. And that used to be Elon's schedule. And when that shifted, I started to worry. At the same time, you look at an executive like Mary Barra, which I get a front row seat to at GM. They've taken half of Tesla's share and have become the number 2 player, largely because she is focused on product like a laser. And along with Mark Royce and Sterling Anderson and the rest of that team, they are doing incredible product work. And that's why the market is talking about their product and not CEO comp, because their product is clearly landing in a really unique way and a powerful way with the customer.
I am glad you brought that up, too. I mean, we should just point out you do sit on the board of General Motors as well. It gets to this idea, though, John. I mean, you kind of know where the puck is going, or at least I think you would know. All the hay we made, I think, early this year about the slowdown in EV sales, not just with Tesla, but overall, is that just kind of a blip in the road that we're just kind of getting this reset here, and we will see that broad mass adoption even without the aid of, government incentives and other things that got rescinded with the Trump administration?
Yeah, my sense is it's not if, but when, because if is going to happen. Who doesn't want a product that has got low to no fuel costs, low to no maintenance costs, actually performs better when you're driving it, the center of gravity is in the right place, et cetera. And that's why the adoption curves are happening all over the world pretty rapidly. They've been slowed down here. But there's only so long you can keep that beach ball underwater, and it's going to come up. And so I think everybody agrees that the future in propulsion is likely electric. It's just that the path to that is going to be not up and to the right. But there's no doubt where the future is going to end up. And the question is what role we as the U.S. want to play in that future, because it's going to dominate this industry. And so do we want to give up that role? It'd be a little bit like hanging on to flip phones and telling the rest of the world, don't buy an iPhone. We don't want to be the flip phone maker in the automotive space.
Well, John,
and so I think.
I was just going to say, not a lot of time left. It's interesting to hear you speak with such conviction when it comes to EVs. I spend a lot of time driving. I do not own an EV. This is a purely selfish question. Why can't hybrids be the future? Why can't we meet in the middle here?
I think, well, hybrids, you've got double the propulsion systems, and so you've got double the cost and things that can go wrong. And so if you want the best of all worlds, it's a single propulsion system in the car. But if you or I were driving anywhere else in the world, in Europe, in Asia, what we'd see is roads filled with EVs. And that's because the consumers there have voted with their feet.
All right, John, really great to get some time with you. Fascinating conversation. That is Jon McNeill. He is former president of Tesla and the co-founder of DVx Ventures and of Vista Shares.
I didn't know you were a big shill for the hybrid industry.
I didn't know that either until I started speaking, but I don't know.
Don't worry, I own a hybrid too, so.
Interesting.
Yeah, it is interesting.
I've
wanted an EV, but
really?
another
Where are you going to charge
another
it?
one of my family members, who shall remain nameless, she was adamantly against it. Said
she
had range anxiety, let's just say.
I don't blame her, because that's the whole thing. Anyway, we'll continue this discussion off air, but coming up, it's the top three, where we focus in on the top three movers and shakers at the center of the day's biggest stories. That's next. This is The Close. Well, it's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And up first, Vlad Tenev, the CEO of Robinhood, planning a closed-end fund to give U.S. retail investors exposure to private companies. We know that, again, that is the investing flavor of the week. Interesting that they went with a closed-end fund.
Interesting, too, but I guess that's the way to do it without getting in trouble.
Yeah.
But it also gets to this idea. We spoke to him last week, and just the evolution of this company and just how much it's broadened out, right?
Yeah, big time. Of course, we know that they're starting a social media arm as well, getting into private assets way beyond just being an online brokerage.
I'm keeping an eye on Noah Wiley. Do you remember him? So years ago, he was in a television show called ER, where he played a doctor in an emergency room. Now he's on another show where he plays a doctor in an emergency room. But he actually won an Emmy for his performance there. But more importantly, I thought that was interesting. He was wearing a custom tuxedo made by the healthcare company Figs, which makes hospital scrubs.
No kidding.
But I guess as a way to kind of give a nod to all the folks who work in hospitals and, of course, the companies that outfit them here. I thought that was pretty cool.
Fig shares actually closed the day up 3.7% higher, so maybe a little bit of a bump there. Third on the docket, we have to talk about Martha Stewart, the entrepreneur getting into the beauty business, developing the skincare label Elm Bioscience. In an interview with Bloomberg, Stewart says she has, quote, always wanted to have a beauty brand, as she is very fussy about skincare. You and me both, Martha.
And me. I guess, if it's good enough for Martha, it's going to be good enough for all of us here. Actually, my only question is, why did this take so long? I just feel like she would have been naturally have had a line like years ago.
Apparently, it's been in the works for 5 years, Romaine.
All right. We do have some breaking news here, just real quickly here. Keep an eye on shares of Live Nation. The share is slightly lower in the after-hours trade. Bloomberg reporting that the U.S. Federal Trade Commission is probing whether Live Nation's Ticketmaster has actually done enough to keep bots from illegally reselling tickets on its platform. All right, we'll get you some more details on that, but when we come back, a conversation with Gary Vee. This is Bloomberg.
We have a framework for a TikTok deal. The two leaders, President Trump and Party Chair Xi, will speak on Friday to complete the deal, but we do have a framework for a deal with TikTok.
Scott Bessent, the U.S. Treasury Secretary, confirming that President Trump and Xi Jinping of China will speak Friday on trade, but more importantly, to finalize that long-awaited deal for TikTok. Joining me right now to talk a little bit more about, well, just the broader digital media landscape. We want to bring in a legend in that space, Gary Vee, the chairman of Vaynerchuk, and John Hu, the co-founder and CEO of Stan. It's an all-in-one platform for creators. The two launching a partnership to make monetization accessible for every creator. And TikTok, Gary Vee, as you know, has really sort of changed those dynamics, as well as the economics, if you will, here. Talk about how important TikTok is right now for the creator community.
It's one of the most significant platforms that has attention in the world. And so if you're a creator, if you're a Fortune 500 company, it's important because it has an enormous amount of attention. And to their credit, they've also been a platform similar to Meta that continues to innovate. And whether it's live shopping or whether it's virtual influencers, they've shown a great tendency of updating their app, which I think was a real issue for Twitter and sometimes Snapchat.
When you look at TikTok, John, and you look at the ability for creators to actually make money for what they create, do you think it's been viable?
So I actually think it's a really hard problem to solve for most creators. I'm actually incredibly grateful for my experiences where my first ever video I ever posted was on TikTok. I got my start on TikTok from nothing in a grad school dorm room with just my phone. But to build a real, viable, durable business for yourself as a creator entrepreneur, you need much more than that. You need to own your audience outside of any of these platforms that can come and go, right? You need to build your own business, and that's what we do here at Stan.
Interesting. So basically, you can't just be a TikTok star. You also have to be across Instagram, YouTube, etc.
That's exactly right. You have to basically build your own media business like Bloomberg is today, distributing through multiple different channels, and then running a viable, profitable business on the back end, which is incredibly difficult to do as a single person.
Thank you. And Bloomberg is a great media.
But I think what's happening here is we're getting into the maturity of the space. I've had the luxury of being in it truly from day one, and the platforms are incredible because they are free. And they give you the biggest asset, which is attention. One of the reasons I partner up with John is over the last decade, what's very clear is if you become over-reliant on one platform, you become incredibly vulnerable. And even if you're like me, who's one of the few people that is heavy on every single platform, if you're talking about monetization, you start to understand why apps like Stan are incredibly important.
Well, talk to us a little bit more about your partnership, your tie-up here, and what you guys are trying to achieve.
Please.
So, our mission stands really simple. It's just to empower anyone to make a living working for themselves. It's very, very difficult to do that as a solopreneur or a creator or an entrepreneur. And I still remember 5 years ago, I was thinking about going back to a corporate job versus posting content, which is, I wanted to build my own business. I felt a little unfulfilled. And 5 years ago, there was a singular man that convinced me to actually get past my fears. This is that full circle moment. It's Gary Vaynerchuk yelling at all of us through the screen to actually get past our fears and do it. And so at this point with Stan, we've built the simplest and easiest way to start your own online business. For just $29 a month, you get all the tools you need. Your website, your courses, your subscriptions, any product you want to sell. But what we've learned about succeeding as an entrepreneur is you don't just need the tools, you also need the education and the accountability.
And you're getting that from Gary.
And that's exactly what we're getting at scale.
For me, watching everyone trying to get brand deals or sell their t-shirts was great. And I'm thrilled that that became viable for people. But what Stan enabled was, kind of like when WordPress came out back in the day, like now normal people could have websites. Or what YouTube did for me, like normal people could have video platforms. To have a Swiss Army knife that can do it all. But to your point, the thing that we think a lot about is like, people just give up. Like there's a ton of people watching right now. They're like, okay, good, Gary Vee, but I tried to be the next big influencer. The reality is, and I've said this a lot to John, I think we're in this wild place where it's creator, entrepreneur, and entrepreneur creator, right? When you look at Liquid Death, when you look at Poppy, some of the stuff you've covered here, they were entrepreneurs who became more famous and started to use social and other apps. But there's a long tail that's watching right now that wants to make 100 to 250K a year, and these are the tools they need from Stan.
On that point, it's interesting you bring that up because we have a lot of entrepreneurs on this program, from the kind of the new era, and it's amazing to see how much they built their businesses using social. That wasn't how they necessarily started, but that was sort of the growth story. And it wasn't just posting and saying, hey, look at this great product. It was, starting a podcast or, just engagement.
That's right.
And I am curious as to somebody is starting a business today. I mean, what is kind of the general advice you would give them and how to engage on those platforms and not just be seen as just trying to sell?
Well, it becomes a mentality game. I think it's not super hard to know as a human being that's watching right now that are you trying to extract value from your audience or are you trying to give value, right? I literally wrote a book called The Thank You Economy. It's give, 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 give. The reason something like Stan is required is when you go in for the ask, the tools don't exist on social for you to maximize, nor do you own it. What happens this is something you've covered. What happens when a platform blocks you or bans you? You're out of business. And so the answer to your question is, if you're giving value or if you're taking it. Too many people just want to sell something. Right. They're not providing actual value.
Is that only going to work for newer people? I mean, like you take a massive content creator, like what we've seen. Mr. Beast is probably the wrong example, but somebody at that level who is so wedded to one platform. And obviously he's found a way to kind of break free with that, with the Netflix deals. And you've seen that with a couple other things like Waveform as well. Do the mature sort of creators, meaning the ones that have been in this space, do they have an ability to break free from those platforms?
I think so. I think they have unlimited leverage. Once you have attention, you can move that around. I actually think most creators are not strategic enough. I think they become over-reliant. I think most creators are insecure and they have 3 million followers on TikTok, and so they don't go hard on Instagram because they only have 100,000 and they're not creating more diversity. That has been the pillar that I've taught everyone on. Go to all these 8. This was my final piece, but I'm serious. What I didn't have was a home where your subscription product, your community product, all the things you see a Discord or a Substack do, when you really think about what they're doing, and they'll have competitors, like this is clearly what's happening. The individual empire is upon us, and literally the long tail of monetization and being your own business around your interests, whether that's sailing, golf, wine, or business, is truly here. And now they need more tools than just attention. For 15 years, I've been yelling about the attention. Now they need a tech stack to take that attention and convert it into bigger economics than pennies on the ads or a random DM from a brand saying, I'll give you some bucks to post this.
Right. Well, I think what you're saying about, people need to be strategic is really interesting because it's tempting to talk about social, about the platforms as sort of a monolith. And John, I'd love to hear you weigh in on this. I mean, how much of the conversation should be spent on which creator, which business works on which platform? Because what's going to resonate on YouTube isn't necessarily going to resonate on a TikTok, for example.
Well, we all as creators or humans have our different artistic mediums that resonate, right? So I actually build a lot on YouTube because I love the long form of building a connection with my audience through a vlog. And every single creator, I think, skews towards their specific platform. But if you want to build a resilient business over time, then you have to think omni-channel as any other business would. Right? It's the famous Jay-Z quote, I'm not a businessman, I'm a business, man. And so what
I say that in the mirror every morning.
I love it. I love the mentality. And so it's through that process that you use Stan, actually, and we're launching an AI agent soon that'll actually help you repurpose content to new platforms, help you build that really resilient business across multiple channels. That's how you think about how do you build not just a funny account with lots of posts, but a real resilient brand.
All right, guys, got to leave it there. Really enjoyed this conversation. That is Gary Vaynerchuk. He is chairman of VaynerX, and John Hu. He is co-founder and CEO of Stan. This is Bloomberg. Welcome back to The Close. Let's get a checkup on Hinge Health. Shares up more than 50% since its IPO in May. The San Francisco-based company helps users get access to a personalized exercise program in order to reduce joint and muscle pain. And joining us now to discuss, I'm pleased to say, is the man in charge, Daniel Perez. He is the CEO of Hinge Health. Dan, great to see you in person.
Thanks for having me.
So you take a look at the sell-side embrace of your story just in the past week or so, seeing 3 price target upgrades and some folks coming out and initiating you as well. Clearly, this is a stock that Wall Street is excited about. Now that you have the IPO firmly in the rearview mirror, what's next for Hinge Health?
Well, look, our vision is to use technology to scale and automate the delivery of care, and we've started with just physical therapy. It's only 1.2% of total healthcare costs, but it's about a $60 billion market in the U.S., and we want to keep chipping away and peeling away aspects of in-person care to use technology to automate it, because the fact is with healthcare is still a services industry. Despite all the technology we have in healthcare, all the machines you'll see whirring about in a hospital, most care delivery itself is still remarkably manual. So we started with PT. We've got a lot of runway to go with PT. We're at a $500 million run rate of a $60 billion market. So a lot of runway to go with PT, but our aim is to continue to use technology and apply it to other areas of healthcare so we could automate it.
Well, let's get specific here. So a lot of runway when it comes to PT. Looking beyond that, though, where else do you see as potential white space for Hinge?
Well, we have about 500 people on our R&D team, and I'd love to tell you more around what our next products are. We're gonna have them come back when we announce it, but I'm not allowed to. We could bring them by. We can't announce what the next products are. But I would say the challenge with healthcare is very acute in that. In every other aspect of our economy, when technology comes in, it makes things better and typically a lot cheaper. Think about your sedan. The features you have in your car today were considered luxury years ago, and that's thanks to technology. In healthcare, that equation is upside down. Technology is often used as an excuse to raise prices in healthcare, and our aim at Hinge is to continue to automate more aspects, and we've been able to automate about 95% of human clinician hours associated with physical therapy, and we think there's more areas of healthcare that can be automated, but healthcare is hard to be automated. All non-touch aspects of healthcare could be automated now, but touch aspects are a little harder.
Well, that's what I'm going to ask you, because I mean, healthcare is different than a car. I mean, healthcare by its very nature, you want somebody touching you, you want a doctor or a physical therapist looking at you directly and being able to, figure out what's going on. How does the technology facilitate that, but at the same time, make me still comfortable that the person evaluating me is going to truly know what's wrong with me?
Yeah, you're absolutely right. Healthcare is different. It's very personal to each one of us, and that's one of the reasons it's been difficult to bring technology to automate that care interaction itself. And we've tried to be very, very thoughtful in how we build our products. So how Hinge Health works, Jen, I'll tell you a little bit around Hinge Health works and why the automation in healthcare is really needed. So what we've done with Hinge, we've used technology to scale and automate 3 key aspects of physical therapy. One, we use the front-facing camera on your phone, and via computer vision, which is a subfield of AI, we could track 100 unique landmarks on your body, so we could take you through your exercises, your stretching and strengthening activity for physical therapy right from the comfort of your own home. We also have a pain management device. I actually brought it with me. So a hardware device as well that delivers electrical nerve stimulation. It's about the size of a $50. And this gives people a technology alternative to pain medication. It's non-invasive, non-addictive approach to reducing your pain. And with generative AI tools, we're able to scale the throughput of our care team. Now, you might say, well, do people want technology delivering my care? Do we want automation? Don't I want humans delivering my care? Well, I'll tell you what, the status quo isn't working right now. Right, the status quo is really high prices, really long wait times. Most of our interactions with our healthcare industry today is with like a reception desk or with the billing department. The actual interaction one-on-one with the provider is very limited, actually.
So when you look at the structure of your business and where it can go or how much it can grow here, there's going to be a question here about competition. I mean, what you're doing, other companies have tried to do it. I do wonder if a big healthcare company decided to swoop in and say, we can create our own version of Hinge Health in some form or another. I mean, what's your, to quote Warren Buffett, what's your moat?
So we have a couple of entry barriers, and I think you're asking the right question. When it comes, my perspective is when it comes to Porter's 5 forces, they weren't all created equal, and the force that matters the most is entry barriers. And we've really thought about what are our entry barriers to our business. Now, very large healthcare incumbents, as you mentioned, like the large health insurance companies, the pharmacy benefit managers. They are good at a lot of things. Technology development is not one of them. And so we've been able to demonstrate that we could do things that these very, very large health insurance companies cannot do. And then there are partners, by the way, which I'll get into one of our moats. The other question you should ask, well, why don't the technology companies do this? You know, the big technology companies like Google or Apple or Amazon, why don't they do this? And they have looked at healthcare and the TAM involved with healthcare. They've salivated over that for a very long time and frankly fallen over themselves trying to figure out healthcare reimbursement. It's taken us, you know, it'll be 11 years in October to really crack the business model necessary for healthcare, and the big tech companies haven't been able to do it. Then you think about the other risk is like new entrants of other startups, and we've been able to demonstrate time and again we can hold them back. Now, what are those entry barriers? Well, one, we think our technology is around 3 or 4 years ahead of anybody else in terms of automating physical therapy. And secondly, the channel partnerships we've put in place with health insurance companies allow us to access customers without having to worry about contracting, IT security, procurement. So we're not only the best product on the market and the most validated, we're really easy to buy. And for an enterprise purchase, that makes a big difference.
All right, Dan, we have to leave it there. Daniel Perez, Hinge Health CEO. We'll be back in a moment. This is Bloomberg. All right, let's take a look back at this day in history. Back in 2008, when Lehman Brothers, the fourth largest U.S. investment bank, became the biggest bankruptcy filing in history. The 158-year-old firm, which has survived the railroad industry turmoil in the 1800s, the Great Depression in the 1930s, and the collapse of long-term capital management in the 90s, finally succumbed to crisis itself, the subprime mortgage crisis that it, in effect, helped to create as one of the biggest underwriters of the asset-backed securities that were being crafted with looser standards out there. Rising homeowner delinquencies fed into collapsing mortgage bond valuations, which of course fed into a global liquidity crisis, which fed into what would become the greatest recession since the Great Depression. Lehman, which employed about 25,000 people, listed more than $613 billion of debt in its Chapter 11 petition, dwarfing by more than fivefold what had been up to then the largest bankruptcy ever, and that was WorldCom's 2002 insolvency. Lehman's filing the Monday morning of September 15, 2008 came a couple of days after the Fed declined to guarantee its loans, as it had done for Bear Stearns just 6 months earlier. And it came after talks for a lifeline from Bank of America broke down. Bank of America the day before would actually agree to buy the struggling Merrill Lynch instead. So amid all the talk then of banks being too big to fail, Lehman curiously became the bank singled out as being okay to fail. Now, there's not enough time to go through all that why, but the episode, along with the other near financial failures of 2008, reshaped Wall Street, reshaped our economy, and reshaped our national politics. Funny enough, the Lehman bankruptcy is still not fully resolved. The liquidation that began 17 years ago is still going. Court proceedings for Lehman's brokerage business, that finally closed out in 2022, but the parent company is still a bankruptcy estate as litigants and lawyers continue to sift through its remaining assets. Katie?
Well, our next guest spent decades at the Federal Reserve, including during the great financial crisis. Joining us now, I'm pleased to say we have former Kansas City Fed President Thomas Hoenig, now Distinguished Senior Fellow over at the Mercatus Center. Fantastic to have you with us, Thomas. So as we count down to September 17th and that Fed decision we're going to get, the big question is not whether they're going to cut rates. It's whether or not this is a one-off insurance type of cut or whether or not this is the start of a rate-cutting cycle. And I wonder where you fall on that question.
Well, I'll tell you what I suspect and then where I fall. And I suspect this is definitely a cut that's almost a certainty. And I think in the press conference, everyone will be asking, is this, we're going to have one or two more? And there's a lot of evidence that there may be additional, given the pressure being put on the Federal Reserve and the fact that the job numbers have been surprisingly adjusted down for some, at least. So I think there'll be a lot of pressure that this will go on. I do think, though, I'm going to point out to you that inside the meeting, there may be some who will say, wait a minute, let's think about this a little more carefully, given that inflation is well above our goal, that we have stagflation, and that fiscal policies, given the recent budget pass, are going to be fairly stimulative. So we ought to be more cautious. So I think there will be I don't know if it'll be a full-scale debate, but at least a discussion on whether this should be just a one-off. And I think there's evidence that it should be a one-off only.
It'll be interesting to see. I mean, we won't see, but it'll be interesting about that debate behind closed doors. At the same time, Thomas, they also have to update the dot plot, give their economic projections. Yep. And I am curious as to how much you think they're going to be willing to telegraph on that front.
Well, I think within the committee, they're going to give their best guess, and it is a guess. And I think there'll be a fairly wide range, because I do believe that some of the members will be a little more concerned about inflation and where things should be as they go forward, and they'll do their plots accordingly. So we'll see more variation, and we'll see more debate inside there. And I do think that it's a tough call. I think the Fed has a real difficult needle to thread here, because we do have a lot of stimulus in this economy. I mean, the construction industry, I talked to people today, they're backed up. That's how much stimulus there has been. So if they lower rates, the aggregate demand in the economy is going to increase, and there will be more upward pressure on inflation, I think.
Well, to that point, potentially more upward pressure on inflation in the pipeline. There's also a lot of concern about the labor market, and you've heard a lot of conversations about the two sides of the mandate being in conflict right now, and whether or not there's been a pass-off over whether the Fed is more concerned about inflation or the labor market. I suppose listening to Jerome Powell will get a clue on Wednesday.
Yeah, they'll be listening very carefully. There'll be questions about the labor market. But remember, when you say it's a trade-off, inflation is well above its target. 2% is its target. Price stability is 0. So it's 3% right now. So that's going on. But the labor market, for all the adjustments that are going on, is still, the unemployment rate is 4.3%. That is not no one wants to see it higher, but that's not well off its mandate in terms of maximum employment, given the immigration activities that are going on and the differences there. So I would say if he talks a lot about labor, I would be a little bit surprised as far as it taking the heavier weight in terms of their policy choices. If they rely on the jobs number heavily, I think it will be a surprise and a disappointment.
All right, we have to leave it there. Thomas Hoenig, former Kansas City Fed president, and of course the big preview here of that big meeting that starts tomorrow. Kind of interesting here. We still don't know if Myron is going to be there. We don't even know if Lisa Cook will be there either. I don't know if that changes the outcome, but certainly adds some intrigue.
That's the thing. The politics almost as interesting as the policy, with that dual mandate potentially in conflict right now.
That does it for us here on The Close. We'll be back tomorrow with all of your market moving coverage. For your politics coverage, stick around. Balance of Power is coming up at the top of the hour, right here on Bloomberg.